Hello and welcome back everyone. Today we will cover our second topic, key accounting principles and valuation for innovative companies. Some of these principles will apply also to established, more mature companies, but innovative, young startups usually follow different rules compared to older, more established counterparts. So we'll start by discussing a few principles that are useful in guiding your thinking around these topics. And in the next classes, we'll also discuss valuation in more details. So the first principles are that real, human, and financial capital must be rented from owners. And when we talk about owners, we talk about different type of owners. For example, when you're looking at human capital, we are obviously talking about the employees. When we are talking about financial capital, we are talking about the owners of capital, the suppliers of capital. So since every type of capital, including financial capital, has a cost, the question is what defines the cost of financial capital? There is a number of things that will affect how much you will pay for the capital you're receiving. And it doesn't matter if you're raising equity or debt capital. So if you're getting a mortgage or if you're getting shareholders, investors in your firm. So the owners of financial capital will want to be compensated for the risk that they are taking. And they will be looking for higher return on their investment depending on mostly two things. Number one is the time value, and number two is the risk that they are taking. The two are obviously interrelated. Longer term investments also carry higher risk. But you can think about the cost of capital as being impacted by time value and risk. These two factors can be looked at in everything being equal. Of course, there is also external factors such as the economy or just offer and demand of capital. But if all these remain constant, your startup will need to pay higher or lower cost of capital compared to another startup depending on time value and risk. So just to give you a brief outline, time value is the cost of the capital depending on how long the capital will be locked into the investment. So for example, 1 month, 6 months, or 30 years. And risk can be perceived in different ways, but in general, more risk equal higher cost of capital, and so higher reward for your investors. Let's look at both in more details. For example, when you look at time value, this is a slide from ASB, a bank in New Zealand. You can see here that from 12 months onward, the cost of capital is increasing. So for example, 12 months, the bank will require 4.39% interest rate per year. If you're looking at 60 months, it's 5.59%. So here, the general rule is that the longer the investments in terms of time, the higher will be the cost of capital. So a 2 years mortgage will probably be cheaper than a 5 years mortgage than a 30 years mortgage. And the same we'll see later on applies to companies. In terms of risk, again, as we mentioned before, higher risk means higher reward required by your investors. So for example, if you're looking at a bank, what is the mortgage risk for the bank? What are the risks that the bank is facing when they are going to lend you to buy a house? Later on, we'll discuss these risks in terms of companies. Think about it, eventually pause the video and think what type of risk your bank is facing when you're asking for a mortgage. There are two risks. So the first one is loan to value, means asset risk or the risk of not recovering your credit, which depends on the second risk, which is your creditor risk profile, also named borrower risk or risk of default. So the risk number two means that the banks want to lend money to a person who has maybe a safer job, a stable income, and so that is able to pay back their mortgage every month. In case you are not able to pay, the bank will resort to repossessing your house, your assets. And so if you're asking for a higher loan to value, which means that you're asking for a bigger mortgage compared to the value of your house, this means that the bank has higher risk on not managing to recover the entire credit. For example, you can ask for a loan to value of 70%, which means that you are trying to raise a 700,000 mortgage on a property which is worth 1 million. So 700,000, 1 million, loan to value is 70%. You can also get a loan to value of 80%, which means a mortgage of 800,000 on a 1 million property. The problem is that if the house value goes down, let's say to 70%, if you had a loan to value, sorry, to 700,000, if you had a loan to value of 80%, the bank will not manage to get all the money back. So for a company, these are the two main risks that they are going to evaluate when giving a mortgage. So if you have an unstable job or a lower salary, or you're asking for a higher loan, this will mean that the bank will face higher risk, and so they're probably going to ask for a higher interest rate. Similar reasonings can be applied to companies. And of course, when we look at a company, what are the criteria that you think increase the risk that your investors are facing? Again, feel free to pause the video and think about this before the next slides. So a number of factors will affect how risky a company is, both from a lending point of view as well as an investor's point of view. So for example, the age of the firm. Is well known that younger firms are generally more risky. And this is because usually they don't have much revenues, maybe they don't have enough customers, and the management is inexperienced. All these factors will increase the risk of your investors, and so they might want to, they might require higher return on investment on their capital. In the case the firm has assets, this will also lower the risk of your investors. And usually banks only want to invest in companies that have assets that they can guarantee the loan. But if you're looking at the startups, probably the amount of assets will be very low or will be intangible, so very hard to evaluate from bank point of view. So thinking about startups or innovative young companies, in general, there is a lot of risks that investors face. In this slide, there is some statistics from US research, and you can see that 95% of the startups fall short of meeting projections. 80% fail to see projected return on investments. And in general, a good portion, in this case, the research finds 40% liquidate and lose most or all the investment. So if you're looking for money and you go to a business angel or a venture capital, you need to think from their point of view. When you talk to them, they have almost half chances of losing all the money that they're investing in you. And so, of course, they will require higher return on investment, especially if the company is young, again, with an inexperienced management, with very few customers or revenues. So cost of capital for young tech companies is usually very high. This slide, I like it because it shows a dynamic point of view. So what this slide tells you, it's all the different years. So every line, every different color is a company started, for example, in 1994, 1995, 6, 7, 8, and 9, and so on. And what this shows you is that, for example, after 5 years, you can see here approximately 5 years, 50% of the companies are bankrupt. They will not be surviving. After 17 years, the number of companies surviving is only 25%. So again, think about it from a bank's point of view, from an investor's point of view, the chances of you staying alive are very low. So again, they have a probably 70% chance that you will not be alive in 15 years. And so 70% chance of losing all their investment. So they will require significant return on their investments. And so what is the reasons why startups fail? And later on, I will also explain what type of return your investors are looking for. So the main reason for failure of startups, think about what they are. Again, pause the video, and in the next slides, we'll discuss them. So the main reason is that there is no market need. And this is also one of the important topics of this course, is for you to learn how to do a business plan, how to do market research. Because most companies, they start with the idea some customers will come, someone will buy, Or some entrepreneurs say the market is huge, say it's $10 billion or 1 million people interested, someone will buy my product. But 99% of the time, no one will buy your product. So understanding what is the market need, how you can solve that market need better than your competitors is very important to avoid failure later on. So spend extra time, do market research. This investment will be very valuable and will save you from potential problems later on. Sounds obvious, but a third of the companies run out of cash. So again, in this course, we'll explain how to do a cash flow projection in order for you to understand what could happen to your company. You can change some scenarios to see what will be your cash position, maybe in 2, 3, or 5 years. And also, you will be able to know how much you need to fundraise from your investors in order to be successful and sustainable. Not the right team is apparently very important. 1/4 of the companies have problems, and I've seen this within our teams at the university. A lot of times there is fights, and so it's important to assemble a good team with good skills and with people that can work together. There is a number of other reasons. They are less important, but they are still very relevant. Take some time to think about each of them. So here, I'm showing you 6 famous people. You might recognize some of them, and I will not tell you who they are. It's your role to find out who they are and what they have in common. They have in common at least a couple of things, and there will be a quiz online you can answer for this. Moving on to principle number 3. So an investor's financial objective is to increase the value of their investment over the years. This is usually the main desire that your investors will have. Of course, this does not conflict with other objectives such as treating well your employees or being environmentally sustainable. Usually these objectives are part of the first objective. Because of course, if you're treating badly your employees, probably the company will not do well. If you're poisoning the environment, also in this case, the company will not do well. So think about all these sustainability issues in order to provide value to your company and for your investors. In some cases, especially for business angels, they might be interested in sort of social objectives. They might just want to be part of a group of business angels. They just might want to give back to young entrepreneurs in the same situation where they were maybe 10 or 20 years ago. But again, they only care about the financial objectives. And so the value that your firm will have along the line will depend on the ability to generate cash and pay back the capital to the providers as well as to the entrepreneurs. So what type of returns your investors will expect? This is a question that it often comes up, and usually entrepreneurs are very skeptical. So these returns are for equity investments. For bank loans, they are different. And so the expected return depends on, again, the risk and the time that you are asking your investors to commit. And so if you are looking for seed investments, basically investments to start your company when there is not much, maybe there's not even an office, not even a team, just maybe a business plan, they will be looking for 100% returns every year compounding. So every year they expect to double the capital that they've given you. If the company is a little bit more developed, maybe it has some customers, early revenues, the expected return declines by almost half. So approximately 50 to 80% a year return on their investments. If the company is more established, and so in the development or late stage, maybe 3, 5, 7 years old with some significant revenues, customers, and brand image, the returns dramatically fall, 30, 20, 50% or lower. So you can see that especially compounded, this will significantly reduce the cost of capital. In other words, if you are looking for a very early stage investment, and for example, a business angel is giving you 100,000, they will expect to receive 10 times or more in the following year. So from 100,000, they expect the return to be 1 million at the time when they sell the shares in your company. If you're more established, for example, in the rapid growth stage, they will only look for 4 or 5 times the investment return, and even lower if you are a more mature company. I can understand that this sounds extreme. You think, why would I ask someone for 100,000 when they expect to get 2 million back in a few years? Well, these are expected returns. So remember that half of the companies will go bankrupt. So in half of the cases, they will make zero. And so they need to include these risk projections in the overall return. So in some cases, they will make 100 times the original investment. In some cases, they will make zero. And more or less, they expect to make probably an average of 20% a year on their overall portfolio of early stage investments. So again, keep in mind that they will be looking at these type of returns, and so the valuation of your company will need to reflect this. And finally, for this class, principle number 4, cash and not accounting profits ultimately matter. So if you're a more established company, mature company, usually accounting profits is what your investors will be looking at. But for startups, cash is more important. Some people say cash is king. So of course, you will still need to do your accounting, for example, for government taxation reasons to quantify your revenues and your profits, but cash is what matters, is the new venture's lifeblood. And so there is one important concept which you will often hear is the cash burn. So is how much cash you are burning every month or every year, and also how much cash you still have. So have you have cash for 6 or 12 months or similar numbers. This is important to understand when you will need to fundraise or when you will need to have a break even in order to start generating cash and again, not go bankrupt. So this is the last principle for today's class. Thank you very much for your attention. I hope you enjoyed the class. In the next set of slides, we'll be looking at value creation for innovative companies and how to evaluate the value of innovative companies. Thank you very much. See you to the next class.